Today, we will talk about gapping. Gapping occurs when the price of a stock, or another asset, opens above or below the previous day's close with no trading activity in between. A gap is the area discontinuity in a securities price chart. Gaps may materialize when headlines cause market fundamentals to change rapidly during hours when markets are typically closed, for instance, the result of an earnings call after hours. Gapping can occur in any instrument ere the trading action closes and then reopens. Stocks do this on a daily basis. Currencies trade continuously throughout the week but can still experience gaps between when the market closes before the weekend and reopens after. There are different types of gaps, depending on the size of the gap and where they occur within the overall trend of the asset. Each of these types of gaps can be full or partial gaps. Common gaps are typically partial gaps, as the price doesn't move significantly. However, in some cases, the price may not move much yet and still end up as a full gap. Meanwhile, breakaway, runaway, and exhaustion gaps tend to be full gaps. A trader can have a stop-loss order filled significantly below their stop-loss price due to gapping. Traders can reduce gapping risk by not trading directly before company earnings and news announcements that are likely to have a material impact on a stock's price. During periods of high volatility, reducing position size helps minimize losses caused by gapping. A trader in a short position can also get caught in a gap, resulting in more significant losses than expected. Some traders use gaps for analytical insight. For example, if a gap occurs relatively early in a trend, then it is probably a breakaway gap or a runaway gap, which lets the trader know the price likely has further to run. Other traders use gaps for trading purposes. They may enter positions after a gap occurs. These strategies are called playing the gap. Some stocks have frequent gaps, while others have fewer. Nearly all stocks are susceptible to experiencing a gap following earnings or other major corporate announcements, such as a takeover bid. A stock may also gap because the overall market moves sharply. Take, for example, the $217.50 close. The following day the stock opened at $174.89, just below the second arrow from the left, after a worse-than-expected earnings announcement. In other words, investors who had purchased Meta at $217 would have lost nearly 20% overnight, showing how devastating a gap can be, even if using a stop-loss. A volume increase on a gap helps confirm that the price is likely to continue in the gapped direction. This strategy involves buying into a gap up and is a bullish position. With this strategy, stop-loss orders may be placed at a level below the gap's bottom. A gap up may occur after a positive news announcement, especially if that news is unexpected or better than expected. Positive earnings surprises, news that a stock is a takeover target, or the release or approval of a new product can all result in a gap up. Here are 5 key takeaways. 1. A gap occurs when the opening price of a security is far above or below the previous closing price, with no trading activity in between. 2. Common gaps tend to be partial gaps, while breakaway, runaway, and exhaustion gaps tend to be full gaps. 3. A full gap occurs when the open is fully outside the previous day's price range. 4. Each type of gap provides certain signals for traders. 5. Because common gaps are relatively small and somewhat regular events, they tend to provide little real analytical insight. Hope this would help. Thanks for watching.